Well, here we are in chapter 12, the end of the semester. Look, I don't know about you, but this semester has worn me out. It's a good tired though, because we've learned some valuable information that will have an immediate benefit for your employer and for your future career as an accountant. So forgive my casual attire. It's a little too tired to put on a tie or shave today. The last chapter focuses on payroll. I'm sure you're all familiar with how payroll taxes work, at least at a high level. Let's say you're working at a job making $20 an hour and you work 40 hours. Then you would have earned $800. Earn is the important word here. Even though you have earned $800, your paycheck will be something less than $800. And that's because of deductions that are going to come from your paycheck. The biggest and involuntary deduction that you have is taxes. As an employee, you are required to pay taxes based on the amount of income you earn. You pay these taxes to the federal government and you pay it also to the state government, unless you live in states like Nevada or Florida, who do not have state income taxes. Additionally, we all have to pay Social Security and Medicare taxes. These taxes are not directly tied to the amount that you earned. For example, for every dollar you earn, you're required to pay 6.2% to the federal government for Social Security. That's known as FICA, F-I-C-A. And employee will pay 6.2% of the first $127,000 they earn each year. Afterwards, there's no additional tax due. So in a sense, this tax disproportionately affects the middle and low class who are earning less than that number, $127,000 each year. In addition to the FICA taxes, employees also pay 1.45% for Medicare taxes. Now, this tax does not have an income limit. So to recap, for every dollar you earn, the government will want about 8 cents of that dollar. Then on top of that, you're paying income taxes on the other 92 cents that you get to keep. There are other deductions as well: medical and dental benefits, retirement and charitable contributions, union dues, employer provided life insurance, wage garnishments. This is what you see, but let's talk about what the company and your employer sees and what they do. So let's go back to the example. I'm your employee and I earn $20 an hour. I work 40 hours, so that means you owe me $800. First, the federal government requires you as an employer to withhold federal and state taxes from my earnings. So even though you owe me $800, right? So that's an expense to your business, you will only pay me about $600, right? Which is initially a liability, but ultimately a reduction in your cash. So what happens to the other 200? This is initially recorded as a taxes payable, another liability account. The reason this is a liability is because you, the company, kept $200 of the money that I earned and said, hey, sorry, I have to give this to the government or to to Kaiser or whoever. So when you file a tax return at the end of the year, to the extent it's taxes, maybe the government can give you some of that back. Now, eventually, the government expects to receive this money from the company, that $200. Actually, they're paid around twice a month, but the actual payment schedule depends on how big the company is and how much their salary expenses are. So for federal purposes, the form they are required to complete is a Form 941, and it's on a quarterly basis. In the state of California, it is called a DE 88 form. I should also add that an employer has another responsibility. So as an employer, they agree to share part of the tax liability with the employee. This is what I mean. Remember the discussion about 6.2% of every dollar earned is for Social Security and 1.45% of every dollar earned is for Medicare? Well, actually, it's 12.4% of every dollar earned is Social Security and 2.9% of every dollar earned is Medicare. So actually the government is getting about 15 cents for every dollar that you earn. When you are an employee, the employer agrees to pay half of your FICA and Medicare taxes. So let's get back to the example. As an employer, right, let's say you're paying me $20 an hour and I work 40 hours. Well, your salary costs are $800, right? That's what you owe me. That's what I've earned. But there are additional costs, payroll tax expense, for about, let's say, $64. So the employer, you, would have a total expense of $864. 800 of that is salary expense, and the other 64 is payroll tax expense. If you're not an employee, but you're still earning money, like an independent contractor, then you are required to pay for that total 15% of taxes, plus your federal and your state income taxes. Quite a somber way to end the semester, huh? So look, I should say before we get started, most of the features that you learn throughout the semester are standard on QuickBooks Online. The payroll feature that you're going to learn, you'll be studying this week, is not a standard feature. It's an add-on that costs additional money for the employer based on the number of employees that they have. So in this chapter, we're going to go